If you hold cash, you lose purchasing power. If you invest in investable assets and wait, the central bank will do your job for you. They will devalue the currency, they will push asset prices up, and over a long enough time frame, stocks always go up, Bitcoin always goes up, gold always goes up, real estate always goes up.
Pompliano begins by highlighting the benefits of cheap capital for investors. When interest rates are low, it becomes easier for investors to borrow money, leading to increased investments and higher asset prices. Historically, periods of cheap capital have been favorable for markets, as more money flows into investments, pushing asset prices upward. However, Pompliano cautions that not all investments are equal. Investing in poorly managed companies or volatile assets can still lead to significant losses, even in a favorable capital environment. He also underscores a fundamental truth. Holding cash leads to a loss in purchasing power over time. With inflation and currency devaluation, the real value of cash diminishes. On the other hand, investing in assets such as stocks, Bitcoin, gold, or real estate can protect and potentially grow purchasing power. The logic here is simple as central banks devalue currency through inflationary policies. The nominal value of these assets, which are priced in that currency, tends to rise. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Having cheaper capital entering the market will always be good for investors structurally, right? It means that you can borrow more money. It means that people are investing more historically. It means that asset prices are going up, etc. Now, the caveat is if you invest in a bad company, it can still go to zero, right? So it's not just like, oh, indiscriminately, go and put money everywhere. But also what I think ends up being a reminder to people is from a structural standpoint, if you hold cash, you lose purchasing power. If you invest in investable assets and wait, the central bank will do your job for you. They will devalue the currency, they will push asset prices up, and over a long enough time frame, stocks always go up, Bitcoin always goes up, gold always goes up, real estate always goes up, etc. And it is because that structural advantage where these assets are priced in dollars, the dollar gets devalued, and somebody who is going to buy the asset from you in the future needs more dollars to buy it from you than what it would take today. But the structural setup of the world that we live in today is very important to understand. And so blindly just saving is actually a guaranteed way to lose purchasing power. Investing obviously is what can protect and grow your purchasing power.
Looking ahead, Pompliano notes that the Federal Reserve is hinting at potential rate cuts, which could begin as early as September. If the Fed decides to lower rates, this could lead to a surge in asset prices, particularly in stocks, cryptocurrencies, and gold, which are already at or near all-time highs. Lower interest rates mean cheaper borrowing costs, encouraging more capital to flow into the markets, driving up prices further. He also points out that with interest rates currently above 5%, money market funds have attracted over $6.4 trillion in assets, an all-time high. However, if rates begin to decline, investors may start to move their money out of these low-yielding funds and into higher risk, higher return assets like equities or cryptocurrencies. This shift could further amplify the upward momentum in asset prices.
The Federal Reserve will always kind of be behind the curve because they are looking at data and metrics that are backwards looking. You get the inflation number after the month has expired. You get the consumer spending number, not in real time, but after the people have spent money. And so they're looking at backwards data, trying to make a decision today with the prediction of the decision that's made today, how it will affect the future. So backwards data for a decision today on how it impacts the future is a very hard task to do. And so they will always be behind the curve because of that backwards looking data. Now, there are many people who criticize the Federal Reserve, including myself. I think that they have made many mistakes throughout the years, and you could even argue that maybe the human intervention of monetary policy is not the right way to set up the system. But if you are going to criticize them, you also have to give them credit when they do something that is right. And the one thing that I think that they've done very well is they went from a high inflation environment where they essentially had exhausted all of their stimulus tools. They printed trillions of dollars along with fiscal policy decision makers, and they had suppressed interest rates down to zero. Inflation took off. They have been able to bring inflation down. I won't argue about the exact data point of the official metrics versus the unofficial, but inflation has definitely come down, or the rate of change. And they were able to essentially reload their ammunition. And so if you think about it from the sense of, they were fighting the economy. The economy was slowing down, and so they wanted to stimulate it in 2020. And so they came in and they shot all their bullets. Well, the economy took off, and so the bullets worked. But now all of a sudden, you've got a Federal Reserve that's shot all their bullets. If all of a sudden you need to fight again, you don't have any ammunition in the gun. And so what they have done from 2022 until today is they reloaded. They literally went and they were able to get interest rates back over 5%. And they were able to sell about $2 trillion of assets off their balance sheet in the last 2 years. So now, if there is some sort of economic slowdown, a market downturn, or even a recession, the Fed can step in and they've got all these bullets they can fire again. They could go cut 200 or 300 basis points of interest rates and still only be at 2.5% interest rates. So they have a lot of room to work with there. Also, they haven't been stimulating the economy. And so they could go print a couple $1 trillion and they would just get right back to where they just were in 2022 in terms of their balance sheet. And so what's interesting to me is people don't want to give them credit for that reload. Everyone wants to yell and scream about what happened in 2020 and 2021, which rightfully they should be criticized for. But to give them credit, they have reloaded successfully. The economy did not crash. It is now starting to slow. And so they're ready to stimulate. And so then you go and you look at, okay, he's hinting at stimulating in September. He's going to cut interest rates. What is telling or noteworthy about that is that right now, stocks, crypto, and gold are all at or near all-time high prices. Because because stocks, crypto, and gold are at or near all-time high prices, and the Fed has not been stimulating the economy, that would suggest that when they start to stimulate the economy, that asset prices are going to continue to grow. They're going to take off because you're going to get interest rates going down. So cheap capital will start to flood into the market. And then on top of that, you also likely are going to start getting some quantitative easing measures on the fiscal side where they're going to print money as well. And so one of the other data points that then enters into this is how much capital has gone into treasuries and other money market funds, etc., because of the high interest rates. So once interest rates got over 5%, what we've seen is take money market funds. Money market funds have hit over $6.4 trillion in terms of assets in these money market funds. That is an all-time high. So investors took all this cash and they put it into money market funds to get a higher yield.
Yeah.
Well, when interest rates come down, those people are going to say, I liked it when it was over 5%.
Yeah.
If it's 3%, it's not really worth me leaving my money in a money market fund. So that capital is going to leave the money market funds and go into equities or other assets. On top of that, we have seen countries around the world, people like China and others, that historically have been very large owners of US treasuries. At one point, China and Japan alone bought over 20% of all US treasury issuance. Today, that number is closer to 6 or 7%. They have been offloading their treasury ownership. Now, why is that important? The central banks historically have actually been non-economic buyers of US treasuries. They didn't care where interest rates were. They weren't buying it for the interest rate. They were buying it for the safety net of treasuries, the full backing of the and full faith and credit of the US government. But they have been selling. Who are they selling to? They are selling to financial investors, large financial institutions, etc., who are very sensitive to rates. So what I think is going to happen here is they're going to start to cut rates. Equities, crypto, gold, etc., is going to start to take off. Then everyone holding bonds is finally going to get punished for for the stupid decision of allocating to an asset that is only guaranteed to lose value over time. And then you're going to have that interest rate coming down, which means yields come down. And as yields come down, you're going to see money flow out of money market funds, treasuries, etc., which will accelerate the decline of bonds and will then start to beg the question of who is going to be the net new buyer of treasuries for the US government? Because if they are going to start spending, they need someone to buy the debt. And so it's the whole complex system that kind of reinforces itself, where when they cut interest rates, asset prices go up, but also there's going to be negative side effects to the treasury market, which then will introduce the kind of reinforcement of capital fleeing out of treasuries into these assets, which push them higher. And so him returning to kind of an easy money policy is great from a financial standpoint if you are long. The one thing I will call out that is also coming, if he cuts in September, you are going to hear yelling and screaming from the Republicans because they are going to claim election interference. They are going to say, you have kept interest rates high throughout much of the last 2 years. You did not cut in Q1. You did not cut in Q2. You waited till we were within 100 days of the election, and then you started to cut interest rates and push asset prices up so that people feel like things are going well under the quote unquote incumbent. And so therefore you are actually helping the Biden-Harris administration, which really is the Harris candidate. And so Trump has already called for saying you should not cut before the election. But we also don't want the central bankers making monetary policy decisions because they're looking at an election calendar.
Right.
So regardless of whether they are actually doing it because of the election or not, the Republicans are going to criticize them because it is so close to the election.
Anthony Pompliano's analysis provides a comprehensive overview of the current economic landscape and the Federal Reserve's strategic positioning. He argues that cheap capital benefits investors structurally, but also warns of the risks associated with holding cash in a devaluing currency environment. While the Fed's actions over the past 2 years have successfully reloaded its arsenal for future economic challenges, the implications of potential rate cuts, market reactions, and political considerations create a complex web of factors for investors to navigate. Ultimately, Pompliano underscores the importance of understanding the structural setup of today's world, where investing, rather than saving, is key to preserving and growing wealth. As we move forward, the actions of the Federal Reserve, coupled with market and political dynamics, will continue to shape the economic landscape, presenting both opportunities and risks for investors. Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.